Most beginners think earnings are simple. If the company reports good earnings, the stock should go up. If the company reports bad earnings, the stock should go down. That sounds logical, but it is not how the market works. A stock can report good earnings and still crash. Not because the company suddenly failed, not because the business is fake, not because Wall Street is always irrational. It happens because stock prices do not just reflect what happened. They reflect what investors already expected to happen. That is the survival lesson in this video. The market does not reward a company for being good. The market rewards a company for being better than the expectations already built into the stock price. If you understand that one idea, you avoid one of the most painful beginner traps in investing. Let's build it from the ground up. Imagine two companies. Company A is average. It is not exciting. Investors do not expect much. The stock is cheap, sentiment is low, and nobody is bragging about it online. Company B is famous. Everyone loves it. The story is everywhere. Analysts are raising targets. Social media is full of bullish posts. The stock has already gone up a lot. Now earnings come out. Company A reports numbers that are only slightly better than expected. Nothing amazing, just a little better than people feared. The stock jumps. Company B reports strong numbers. Revenue is up, profits are up. Management sounds confident. But the numbers are not as perfect as investors hoped. The stock drops. To a beginner, that looks insane. How can the average company go up on okay earnings while the great company falls on good earnings? Because the market is not grading the company in isolation. The market is grading the company against expectations. That is the hidden opponent beginners do not see. Every stock has two stories, the business story and the expectation story. The business story asks, is the company growing? Is it profitable? Does it have good products? Is management executing? The expectation story asks, what is already priced in? What does the stock need to prove? How much perfection are investors already paying for? Beginners focus on the business story only. Professionals compare the business story to the expectation story. That difference matters most when a stock is expensive. If a stock is priced for perfection, good news may not be enough. A company can grow revenue, beat earnings, and still disappoint if investors expected even more. Maybe growth was strong, but slowing. Maybe margins improved, but not as much as expected. Maybe guidance was fine, but not explosive. Maybe management mentioned higher costs. Maybe one important segment looked weaker. Maybe the company beat this quarter, but the next quarter looks uncertain. The headline says earnings beat. The stock says not good enough. Sometimes it is just expectations resetting. Here is a simple way to think about it. Before earnings, investors are silently asking the stock a question. For a cheap, hated stock, the question might be, are things less bad than we feared? For an expensive, loved stock, the question might be, are things still perfect? Those are completely different bars to clear. The cheap stock can win by being less bad. The expensive stock may need to be almost flawless. That is why great companies can become dangerous stocks after a huge run. The business may still be excellent, but the stock may have no room for normal problems. And every real business has normal problems. Costs rise. Customers pause spending. Margins fluctuate. Competition appears. Management gives cautious guidance. A product cycle slows. Growth rates come down from impossible levels. None of that means the company is dead. But if the stock was priced like none of those things could happen, the stock can fall hard. This is why beginners get confused after earnings. They read the headline and think they have the answer. Company beats earnings. But the better question is, beat compared to what? Compared to analyst estimates? Compared to investor dreams? Compared to the valuation? Compared to the price move that already happened before earnings? That last one is huge. Sometimes a stock rallies for weeks before earnings. By the time the report arrives, good news is already priced in. The event becomes a sell the news moment. People who bought early take profits. Late buyers are left wondering why the stock fell after good results. This is one reason chasing before earnings is dangerous. If you buy right before the report because everyone is excited, you're not just betting on good numbers. You're betting that the numbers will be better than an already excited market expects. That is a much harder bet. Now let's turn this into a survival checklist. Before buying a stock going into earnings, ask 5 questions. Question 1. What does the stock already expect? Look at the recent move. Has the stock already run 20, 40, or 80%? Are people talking like the company cannot miss? Is valuation high compared to its own history or peers? If expectations are already extreme, the bar is high. Question 2. What would actually surprise investors? Not what would impress you, what would surprise the market? If everyone already expects strong growth may not be enough. Question 3. Is the stock cheap because people are scared, or expensive because people are excited? Fear and excitement create different setups. A hated stock can rise on stabilization. A loved stock can fall on anything less than perfection. Question 4. What happens if guidance is cautious? A company can beat the past quarter and still fall because the next quarter sounds weaker. Stocks usually care more about the future than the past. Question 5. What is my plan if I am wrong? Do you know where the thesis breaks? Do you know how much you are willing to lose? Do you know whether you are investing for years or trading the earnings event? If you cannot answer those questions, you're not investing. You're gambling around a news release. The survival rule is simple. Do not buy a stock just because you think earnings will be good. Ask whether good earnings are already priced in. That one question can save you from becoming exit liquidity for people who bought earlier. A great earnings report can still be a bad stock event if the stock was priced for a perfect earnings report. That is the difference between business quality and stock expectations. And once you see it, earnings reactions start making more sense. A falling stock after good earnings is not always irrational. Sometimes it means the market expected better. Sometimes it means valuation was stretched. Sometimes it means guidance changed the story. Sometimes it means the stock already ran too far before the report. And sometimes, yes, the market overreacts and creates opportunity. But you only know that after you compare price, valuation, expectations, and forward guidance, not after reading one headline. So the next time you see a stock drop after good earnings, do not immediately assume the market is stupid. Ask the better question. What was the stock already priced to deliver? That is how you stop reacting like a beginner and start thinking like a survivor. This is Market Survival School. No hype, no guru fantasy, just market survival.